tell me a little bit about some of the competitors and how you're different?
So the number one both competitor and helper of us is build in-house, right? So we actually don't describe ourselves as a risk solution or a risk product. We really come in when there's been a decision made at senior levels that the requirements and flexibility and transparency and everything warrant an in-house built system, but they want all of the customizability, the flexibility, the transparency, everything that they could only get from building in-house, with the time to market and ROI advantages of using an external system. So we come in and we say, look,
here's the foundation.
20% of your app is going to be unique, right? And it's going to be unique because you're not starting from scratch. There is no such thing as greenfield, right? You've got existing systems. You've got stuff that you need to interact with exchanges and clearinghouses and counterparties, and you need to get trade feeds in. You've got market data coming from Bloomberg and Reuters and emails, and you've got, like, there's all this stuff that is going to be unique. We can optimize as much of it as we can, but at the end of the day, you're going to have to do some work. But you start out with a clean framework, and you don't have to build, the database work, and you don't have to build a risk engine, and you don't have to implement Black-Scholes-Merton for the 900th time, and curve management, all these fiddly details. So that's kind of competitor number one versus partner number one, right? Because if people didn't need that, basically, if our traditional risk product competitors didn't suck so much, people wouldn't be going for build in-house. I mean, the competitive software out there, it all has some really good parts to it, right? It is mature, it is stable, it has been beaten down in production, their bugs have been worked out, there's tons of features that we don't have, they're great systems in terms of the breadth and depth of the functionality that's there, right? But they are horrible to work with. Right. I mean, I actually had
to work with, meaning changing them later or adding things.
Just the experience. So I'll give examples of two products that people use in this space, both banks and hedge funds, and I'm not going to name them. But when I gave this anecdote, I actually had a VC tell me to my face I was lying to him and ended the meeting, because he said there is no way that a company is earning $150 million a year selling a product as bad as you just said, right? So one of them is, so both of them, and this is in 2013, are two-tier apps, right? So they have a big, rich client that runs on the desktop, and they have a database server. That's it. Right. So there's no service-oriented architecture. There's no web front end. There's just, and all of the calculation happens on the desktop. So one of them, the app that you have to run is single-threaded, right? Completely single-threaded. And up until recently, and this is recent within the last 18, 24 months, while it's processing anything, the whole machine locks up, right? Like because Windows keeps sending events to the app, and they're not pulling them off the event queue even, and so Windows the whole system stops. Yeah, it also can't handle overnight rolls, right? So an overnight roll is basically, if you leave the app up overnight, it will think today that is actually yesterday, right? So it needs to be shut down every night and restarted.
This is your competition.
Yeah. And then it would take, for a decent sized portfolio, up to 8 hours for the app to launch in the morning.
Still, this is your competition today.
They've gotten that down to like an hour or two. And so what everybody would do is they'd run it on Windows terminal servers, and everybody would have to have a script that at 12:30 a.m. it would turn it on so that it was ready for trading at 8:30 in the morning. That's app number one.
I've seen some really scary hacks in some banks in the past.
Right.
Yeah, where it's just like some Excel script runs like the whle risk management for a whole desk, and you're like, "Are you kidding me?"
Yeah.
When I joined Vega,
I ran it on Excel for a long time. Yeah, it was bad.
Excel
we
was
were, and we
everywhere.
were like manually putting in figures. It was, yeah.
When I joined Vega, their risk system was a spreadsheet that had a button that said like go
Macro.
and
Yeah.
and then you would come back 8 hours later, and if you were lucky,
If it didn't crash, yeah.
PDFs would spit out the back end.
Right.
So yeah. So that was competitor number one. Right. Competitor number two. Well, they were quite a bit better than competitor number one because their thick desktop app had 2 threads instead of 1. So they had 1 thread to do the UI and 1 thread to do the processing. So at least it didn't hang your entire machine.
Okay.
But their biggest enhancement one year was they had a Windows 64-bit binary because it was requiring like 16 gigs of RAM to run. And this was like a few years ago when people didn't have 128 gigs on the desktop. So
All right, so you're not worried about your competition, it seems.
Why wouldn't they just buy out if they're turning over 150 million a year? Is that
the biggest fintech company in the space,
Right.
In the world, is SunGuard, which you'd never heard of unless you're in the space. But the most likely outcome for any startup, aside from failure, is acquisition.
Yeah.
Right. So. And there are a lot of private equity guys that absolutely love fintech and capital markets because retail investors don't understand it, so the stocks tend to be undervalued. But private equity guys love it because once you get a sustainable business, it's just throwing off free cash flow, right, which they know how to monetize. So, you saw Vista recently that basically spent a couple $2 billion in the last couple of years hoovering up all of this stuff into the new Mises, right? So there was the old Mises, and then there was stuff at Thomson Reuters, and then Vista bought the Thomson Reuters, and it was all this stuff. But basically, they just slapped all of this capital market stuff into Mises, which is a private company. They spent billions doing it. So why don't they buy us? I think one reason is that in capital markets tech, it's not common to buy an early stage company as a strategic threat, right? They tend to buy free cash flow. So they wait until your revenue is starting to plateau, at which point they say, aha, the revenue is kind of plateauing. They look at the cash flow, they figure out how much they can slash R&D, and then they essentially price the cash flow. So multiples on deals are usually 3 to 5x revenue. Not 10 to 100 times revenue or infinity times revenue in the case of like an Instagram or Snapchat or whatever. The second reason is they don't get it, right? Like they don't understand open source at all, right? Like these guys are, some of these founders are very idiosyncratic characters. They've never experienced something like this. People are waiting to see because, we may end up, I'm just brutally honest, we may end up hitting the wall and realizing, okay, we can get far enough, which we've proven that we can get a number of good, high quality customers, but we might find out that we can't get enough to build a $1 billion business, right? That is entirely possible. At which point we'll figure out what we're going to do. But I think they're waiting to see that as well. Is everybody wants to see the J curve in action, but I think they're starting to get worried rather than just sitting around idly figuring out. They've gone from being dismissive to being worried. So we know that the competitors have talking points on us. We know that we have lost deals recently to established companies, and we know why. And it's those companies have had a lot more time to polish stuff, mature things. They have more functionality, and we're fine with that because we know that in a few years those customers will be at that level, and those customers will come to us because we have things that those guys will never have.